Good afternoon. My name is Ahmed Oumara, and on behalf of LuxFlag, I'm very pleased to welcome you to the next session of the LuxFlag Sustainable Investment Week. Just as housekeeping notes, I would like to mention that for Q&A, if you're watching online, please use the chat function on the bottom right of your screen. For those of you in the room, we will have microphones to circulate, and the recording of the sessions will be made available in a week on LuxFlag's YouTube channel. I'm glad to introduce next session, titled Understanding the ESG Fund Landscape, hosted by Morningstar. Morningstar provides independent research, ratings, and tools which are helping people across the investing ecosystem to write their own financial future. I'm really looking forward to hearing from Morningstar the description of the ESG fund landscape. For that, I'm extremely happy to have with us today Hortense Bioy, Global Director of Sustainability Research at Morningstar. Based in London, Hortense leads the Morningstar's ESG research efforts globally. Hortense, the floor is yours.
Thank you very much, Ahmed. So, yes, it's very good to be here. Thank you for the invitation. I have a few slides that I am going to present this afternoon. So actually, the first one I wanted to change because I realized at the last minute that this slide only has 3 years of history, and I wanted to show you 5 years of history to show you really the significant growth of ESG funds and sustainable funds globally. So I really wanted to start with the global picture to really show you that Europe is really dominating the space. Has been dominating the space for years and still now represent over 80% of assets in ESG and sustainable funds. So this chart was built based on our own data points. So we have, as you may know, we have our own definition of sustainable funds, which we've had for years. So it pre-existed SFDR. Our criteria to define an ESG and sustainable fund are actually stricter. That's why the universe that we show is smaller than the universe that I will show later, represented by Article 8 and Article 9 following the introduction of SFDR in March 2021. So I've actually put the definition up there. For us, an ESG or sustainable fund is a fund that uses ESG criteria at the center of its investment process. So we do not include funds that have only limited exclusions, and we do not include funds that now, say they do ESG integration, so they use ESG factors to mitigate risk without binding ESG criteria. And also we exclude money market funds, fund of funds, and feeder funds to have a cleaner universe. So that was the assets picture. Now the flow picture, you can see over the last 3 years that quarter over quarter flows into ESG and sustainable funds have been positive, which the same can be said about conventional funds, which are represented in gray on this chart. So during market volatility, sustainable funds still attracted money. So inflows during the first quarter of 2021, at the beginning of the COVID crisis, and also so far this year, when, as you know, the market has been quite jittery against a backdrop of inflationary pressures and geopolitical risks. So I think what that tells you is that ESG funds tend to be more sticky and they tend to be more resilient than conventional funds. Now, focusing on SFDR, which is really the topic du jour for asset managers in Europe. It's been really dominating conversations over the past 2 years. Even before SFDR came into effect in March 2021. So just as a reminder, I put out there the definition of Article 8 and 9, but I think now it's become part of the lingo. Just as a reminder, Article 8 funds are funds that promote ESG characteristics. Article 9 funds are strategies that have a sustainable objective. Now, as we know, SFDR is a cornerstone of the EU Action Plan for Sustainable Finance, which aims to reorient capital towards sustainable activities. So SFDR really aims to increase transparency, combat greenwashing, by requiring asset managers to disclose more information, not only about the ESG risk of their investments, but also the impact of the investments on society and the environment. So although Article 8 and 9 are used as labels now, that was absolutely not the intention of the regulator. It was supposed to be just a disclosure framework. So Article 9 funds requiring that asset managers provide more information, more ESG information about the strategy. Article 8, a bit less, but still more than for Article 6 funds. Now, since the introduction of SFDR, so as I said in March last year, the number of funds that have been classified as Article 8 and 9 has significantly increased, and so have the assets. So at the end of June, a little bit more than a third of funds distributed in the EU, 35%, were classified as Article 8 or 9. In terms of assets, the number is even much bigger, 50%. So €1 out of 2 invested in the EU is now invested in a fund that has some sort of green characteristics. I think it's fair to say that no one probably expected this landscape. I think it's fair to say that the regulator himself didn't expect this uptake of Article 8 and 9 funds to be so big and so fast. I'm regularly asked, where do we think we're going to go? Can it go to 75%? Maybe. I think there's going to be a natural ceiling anyway. I think it's going to be probably be around 70%, 75%, but we're not going to go to 90% or 100%. Now, in terms of flows, last year, Article 8 and Article 9 funds had a very, very good start. You can see inflows, so into those funds represented more than half of the flows into funds distributed in the EU in Q4. Now, the picture looks even more mixed this year, against a challenging background, as we know. It's particularly more challenging in aggregate for Article 8 funds, which is more this, all-encompassing category, catch-all category with lots of different strategies, from very, very light green to darker green strategies. But when you look at the flows, in Q1 and Q2, Article 8 saw outflows, while Article 9 funds consistently saw inflows, even if they were small, in Q2. So what does that tell us? Is it possible that it tells us that there is a real appetite for Article 9 funds because they are more resilient, they're more sticky than Article 8? It is kind of evident when you look at the organic growth of Article 9 funds. So what we mean by organic growth. Organic growth is the flows divided, the flow on a specific period divided by the assets at the beginning of the period. So as you can see that the organic growth for Article 9 funds has consistently been higher than for Article 8, and also has been consistently positive so far this year. Now, inflows into Article 8 and 9 funds have been really driven by product development. So I think it's fair to say that SFDR has really acted as a catalyst when it comes to innovation and product development. So since the regulation came into effect, we've seen more than 1,000 funds being launched as Article 8 or 9. And that represented more than half of new funds launched in the EU or distributed in the EU. So when you look at the type of funds that is, I mean, obviously most of those funds are broad ESG funds. They offer broad sustainable they offer exposure to broad sustainable strategies, but also we've seen a proliferation of funds with a thematic flavor, especially focused on the environment, and more so specifically on climate. Now, launching new funds is not the only way that asset managers have been responding to the demand from investors for more sustainable strategies. They've also repurposed or reclassified funds, so they've enhanced the existing strategies. This is what we call the great reclassification. So they've reclassified funds from either Article 6 to 8 or 9, or from even 8 to 9. So that's really like a big trend, and in Q2 alone, we've identified close to 700 funds that had changed classification, and we'll continue to see that. So most of those are, sorry, when I say classifications, I mean upgrades, more than around 700 upgrades. What we're also starting to see is downgrades. So funds now that are changing the classifications from 9 to 8 mostly, not so much from 8 to 6, but in Q2 we identified 16 downgrades. Most of these funds were offered by a very small number of asset managers, mainly two actually, NNIP, which is a Dutch manager, and US manager PIMCO. When we asked them why they did that, well, they say it's because there was further clarification that was given by the European Commission and the IFM, which is the Dutch regulator, in June, that says that an Article 9 fund may only invest in sustainable investment. So they thought that the fund that they had originally classed Article 9 fund would not be able to meet those criteria, so they downgraded this fund. 2 weeks ago, Robeco also announced the downgrade of 7 of the funds, and as we are compiling data right now to publish our third quarter report in 2 weeks' time, I can tell you there is also more asset managers that are also going to announce downgrades. Now, in terms of downgrades from 8 to 6, we haven't seen many. There was one from NN in Q2. There could be more, but we doubt there will be more than downgrades from 9 to 6. So Morningstar, we love league tables. We always like to show the largest this or that. And so here are the largest Article 8 funds. And the first time I looked at this league table, what really struck me is the fact that there was only one fund that looked ESG. But by that I mean that had ESG-related terms in the name. Which I think can explain some of the confusion out there, because I think you would have expected a fund that claims some sort of green credential to have something in the name that would indicate that they have this, some green credential, so this intentionality. But that is not the case, and that's why the Article 8 category is so broad, is that you also have a lot of funds that just consider ESG, or they say they promote ESG factors, but they're mostly, they promote ESG factor, but in a way you would not necessarily expect they do so. So yes, I think this is what also has led some market participants to say that maybe SFDR at the beginning has given the opportunity to some asset managers to greenwash, or because funds that didn't claim any ESG credentials before now do say that they promote certain criteria, when sometimes actually nothing or very little has changed in the strategy and in the portfolio. Now, this is in contrast with the league table for Article 9 funds, or the 20 largest Article 9 funds, where you see more green there. So more funds that, of course, show their intentionality, the green mandate in the name by having some ESG-related terms in their name. Some don't, you can see there, but when you look at the prospectus, you can see that clearly they do have a green mandate. Those two index funds from Handelsbanken, for example, track climate benchmarks. And the Carmignac investment fund, by the way, these are all those, not the Pictet one, but those are funds that repurposed recently, in the last 18 months. And the Carmignac investment is an SDG-aligned strategy. I don't know why they didn't rename, but they didn't. Okay, so it's no secret that because of a lack of clear guidance from the regulator from the get-go, asset managers have interpreted the regulation in their own way, and that has led to different approaches to classification, which in turn has led to confusion and greenwashing accusations. Now, I'm showing here the broad spectrum of ESG approaches that you typically find in Article 8 and Article 9 funds. So this is not exhaustive, and this is constantly evolving. But it's just to give you an idea of the ESG approaches that are used in Article 8 and 9, and also what is overlapping and what is really still in flux at the moment. So Article 8 funds typically are lighter green strategies. So these are funds that have a light exclusion. Sometimes they're not so light, so sometimes they just exclude 20%. They go as far as excluding 20% of the worst. You see that a lot in France because of the ISR label there. And also funds that really are light by just saying, we just do ESG integration. On the far right, you've got the darker green funds, and those that have no doubt, that give no one any doubt, are those impact funds. There are not that many, but these are, what we commonly call impact. And in the middle, you have, again, ESG approaches that you find in both. So these are funds that have KPIs, the ESG KPI, either at the portfolio level or at the security level. You have best-in-class strategies, thematic funds. And now, more and more, because of SFDR, you have also funds that say they invest in a minimum proportion in a sustainable investment. And that can go from a very low level, like 5%, to, as we will see, actually now, 100%, which is a bit weird for an Article 8 funds, but you do see that now. One example I can give you, for example, we've seen thematic funds that have exactly the same name. You read the prospectus, they have exactly the same language, but yet one would be classified as Article 8, the other one is Article 9. I've got a waste sustainable water fund in mind, two of those that are classified differently. Now, in passive land, passive funds are underrepresented in the Article 8 categories, but they're overrepresented in Article 9. In the Article 9 category, it sounds counterintuitive, but that is because of the growing number of sizable index funds and ETFs that do track climate benchmarks, so Paris Aligned benchmarks and climate transition benchmarks. This space has grown enormously since those benchmarks were created a couple of years ago, and now they have close to 90 billion of assets under management. There are over 120 strategies like this. So this is really what's boosting the market share for passive in Article 9. Another league table. So these are the asset managers that have the most assets in Article 8 and 9 respectively. So Amundi is at the top of Article 8 funds. Amundi is the largest manager in Europe, followed by DWS. Nothing to do with greenwashing, the greenwashing accusations that... No, really, I'm serious. Nothing to do that, but then number 2, and JP Morgan. And for Article 9, we've got Pictet because they have this long-standing range of thematic funds. BNP Paribas and BlackRock iShares because, again, or BNP Paribas and BlackRock because of also sizable CTB and PAB passive funds. So the passive fund that I mentioned earlier that follow climate benchmarks. Now, how do those funds stack up against a number of metrics? So we first looked at ESG risk, and what we found is that typically Article 9 funds have the lowest ESG risk. So because the highest proportion of those have either 4 or 5 globes, which means relatively lower ESG risk. So 72% of Article 9 funds have 4 or 5 globes. Article 8 funds also have lower ESG risk than Article 6 funds. So we have 52% of Article 8 and 9 funds with 4 or 5 globes, and it is better than the 34% of Article 6 funds with 4 or 5 globes. Now, looking at other metrics, so some controversial activities like tobacco, controversial weapons, thermal coal. And we also looked at severe controversies, and the majority of Article 8 and 9 funds do have 0 exposure to these controversial activities. However, the same can't be said about fossil fuels and nuclear energy. So I was told actually not to put nuclear energy there because it's not a controversial activity anymore, supposedly. But I thought, I would still put it there. So the majority of Article 8 and 9 funds do have some exposure to fossil fuels and nuclear energy. So I know this exposure to fossil fuels energy, especially in Article 9 funds, always raises questions or eyebrows. But that's because of, again, Article 9 fund, the definitions have been interpreted differently by asset managers, and also you have a lot of strategies that invest in what we call transitioning companies. So these are companies that are not green yet, but they are transforming. They are transitioning to more sustainable activities. So at the moment, there are a lot of them in Article 9 and also, of course, in Article 8 funds. And by the way, these are not, again, breaching, and they're not in breach of Article 9 because the interpretation at the moment is quite, is left at the discretion of managers. Now, moving gears a little bit, because I'm going to talk about Article 8 and Article 9 funds still, but through the lens of the European ESG template, the famous EET, which is a voluntary reporting mechanism that was put in place for the MiFID II requirement that came into effect on the 2nd of August. So you may know, MiFID II requires now that financial advisors ask their clients about their sustainability preferences. And if the client says, yes, I want to invest sustainably, then they will have to accommodate and find products that either have a minimum proportion of sustainable investment, as per the definition of SFDR, or a minimum proportion of taxonomy-aligned investments. Or also they can ask, do you want to avoid certain activities, or do you want to avoid negative impacts? So then they would have to refer to the principal adverse impact indicators. So this is not an easy task. We were talking about this over lunch. Advisors don't have all the information yet because asset managers themselves do not have all the information. So when we looked at, sorry, there's a bit of a problem with the formatting there. When we looked at the data that we received from asset managers on these metrics, we saw that less than half of Article 8 or 9 funds that submitted the data to us have already reported a minimum proportion of sustainable investments, and only over a quarter reported some taxonomy alignment. Now, where the percentage or the coverage ratio is the highest is for PEI consideration. 90% of funds say that they consider or not. Most likely, they do consider PEI, principal adverse impact. Now, looking at the values now, that's when it looks even more interesting, is that it was a bit of a surprise. So, of course, there is a range. It's not a surprise to see that, of course, Article 9 funds, more Article 9 funds, have a higher minimum exposure to sustainable investment than Article 8 funds. But what is a bit surprising is to see that it's, a lot of funds still don't have a very high percentage or targeted percentage exposure to sustainable investment, and we are far from the 100% that supposedly, as Article 9 funds should have. Yeah, there is less than 5% of funds that have between 90% and 100% exposure to sustainable investment. I'm talking about targeted here because it's not the actual figure. And again, here, these are the funds with the highest minimum proportion to sustainable investment. I was actually surprised to see that you have some Article 8 funds that target very high percentages of exposure to sustainable investment, while you have very, very few funds in Article 9 funds that are close to to targeting 100%. So this data is from September. There were only a dozen of funds then. Now there are more, but it's still a very small minority of funds. Now, what's the problem? Well, as I said earlier, asset managers have had to interpret the definition of, and I had to work with their own interpretation of SFDR, and in particular the definition of sustainable investment. What is a sustainable investment? This is the $100 million question. This is the definition that was provided by SFDR, Article 2 of SFDR. But still, it is still vague. It leaves a lot of room for interpretation. What contributes to an environmental or social objective, and how do you test for, the harm that some of those companies can do? Again, asset managers have done very, very different things, which also has added to the complexity of how these investments should be counted in the portfolio. So there are different methodologies. I'm not going to go into the details, but there are mainly two methodologies that are used by asset managers. They can, once they've decided that a company has a certain level of exposure to sustainable activities, then they may count the company fully, 100%, or they can only count the revenue, the part of the revenues that are generated from sustainable activities. The fact that these sustainable activities can be counted differently in a portfolio result in very different percentages at the portfolio level. Of course, if you follow a revenue-weighted approach, you end up with very low, less than 50% exposure to sustainable investment, while you can go to up to 100% if you follow the pass-fail approach. And the problem with that is that, of course, if they all follow very different methodologies, the products can't be comparable. So here I've taken an example, a number of passive funds that track Paris-aligned benchmarks, and they all provide exposure to global large cap. Yet, despite the similarity in holdings, you can see that some funds disclose only a minimum percentage of sustainable investment of 1%, while another fund would say 80%. And this is just because they use different methodologies, basically. So advisors would really struggle to pick funds, for the clients, given this range of practices. And if they can look at the methodologies to understand this better. But this might be a big task to ask for them. Now, that was the minimum proportion to sustainable investment. Now, when you move to taxonomy alignment, there is even lower data. As I said earlier, only 27% of Article 8 and 9 funds do provide this data today, and most of the value that is provided is zero. Even for Article 9 funds. Asset managers are being very, very cautious, of course, with all these accusations of greenwashing, the fact that they do not have the data and they can't estimate the data. They've been told not to use estimated data. They just say zero. So that's not really helpful, right? So we're going to have to wait maybe a few years to get better data on the taxonomy. There is also added to the fact that at the moment there's only 2 objectives that you have technical screening for. It's climate mitigation and climate adaptation. So we need to wait for the social taxonomy as well to provide more detail there. But still, I mean, you still have funds that can report high exposure to taxonomy-aligned investments. Most of these are very green funds, impact funds, and you can also see some green funds there. But the percentage drops very fast from 90% to 21% and then goes down to zero very quickly. Now, moving on to the principal adverse impact considerations. So this is a requirement, and again, it's left to asset managers' interpretation. What does that mean? What does that mean to consider PAIs? Does that mean I just need to disclose, or I need to address those PAIs? So this is something that be asked to the European Commission to clarify. So we're waiting for the answer there. But still, as you can see, even for controversial weapon, not 100% of Article 9 funds said that they consider that. So when we spoke to asset managers, they just said to us, I mean, some said, yeah, for Article 9 funds, we'll always consider PIs, all the PIs. Others will say we will only consider the most relevant ones. So depending on the strategy, some will not consider, like if it's a social fund, for example, do not necessarily expect environmental PIs to be considered. But this is what some asset managers have said. It's not me. Well, a good example here, actually, is, let me give you an example. Well, maybe in the interest of time, I'll move on to the next. I think it's my final slide, and then I'll conclude. I just wanted to talk also about the UK regime, because I think it's interesting what's happening there. So, of course, as you know, the EU has been leading the way, and the UK, post-Brexit, has been actively following what's happening here and learning their lessons. So what they saw is a disclosure regime that actually became a labeling regime. So they thought, okay, we are also going to do disclosure, but we're going to give labels to people because this is what they want. They want labels. So this is what was provided or disclosed by the FCA a year ago in the discussion paper. Now they're going to update this framework at the end of this month. But they say, hey, this is how we see the landscape, and this is what we are going to ask asset managers to do, to put funds into these buckets. So 3 buckets for sustainable funds. By the way, we know now that this is absolutely not the labels that are going to be used. I won't tell you which one they're going to be used, but what's interesting there really is that they thought about creating a bucket, the transitioning bucket, because they obviously know that there would be very few funds that would meet the impact category. And they wanted to acknowledge the fact that there are lots of companies that are really now transitioning, they're improving their business model, they're transforming, and they need to be supported, right? So the funds that have this sort of strategies will be labeled transitioning, or another term they will use. And the interesting thing as well is that they also map that against SFDR, And it would be interesting to see when you map things, once this is live, which funds actually, which Article 8 are very, very light green, and those that are a bit darker green, because they will fall under the sustainable bucket in the UK framework, while they won't, while they may stay there under the UK framework. So something to, keep an eye on. I think it's going to be at the end of this month that they're going to update the market with this framework, and they will finalize it a few months later. Now, just to conclude, so the range of ESG funds has expanded considerably in Europe, boosted by SFDR since the beginning of last year. Clearly, Article 8 and 9 funds do have better credentials in aggregate, especially when it comes to ESG risk. But let's keep in mind that the spectrum, especially for Article 8 fund, is very wide, and there's still a lot of questions about classification. Some funds will be declassified from Article 9 to 8. I mentioned this clarification that we needed from the European Commission. There was a letter that was sent by ESMA and other authorities a few weeks ago, listing a number of issues that needed to be clarified. So hopefully we'll have more clarity on this key definitions and methodology very soon. But this leaves investors really with something that they have to. They have to navigate, and it's not easy. But so what we say to investors is they still need to do the due diligence, not rely on the label 8, on the labels Article 8 and 9 of SFDR, but really do the due diligence so roughly understand the ESG objective and investment process of the funds they're looking at. With that, don't know if you have questions.
Thank you, Hortense. I will ask in the audience if we have questions. Meanwhile, we have one question online, I believe, about the downgrades that you have mentioned from Article 9 to 8, and to a much lesser extent from 8 to 6. Do we see any sort of outflow as a consequence of those downgrades? Does it have an impact on the flows in the AUMs?
Well, I guess it's probably too early to tell. But what's important to understand is that although they're changing the status, the classification of the fund, they're not changing the strategy and they're not changing the portfolio. So nothing has changed, right? It's just that they have to explain to the clients that the classification has changed, and that's it. But yeah, it's too early to tell. But we're doing some research on repurposing, so seeing the other way around, is that strategies that relabeled green, have they attracted flows? And it seems that they have, yeah. And when you look at I don't know, since 2018 we did this exercise. So we used 4 or 5 years of data, and we saw that indeed there was more flows flowing into those funds because of the relabeling. And they also repurposed the strategy. So it's not only they changed the name of the fund, in a lot of cases they've also did something to the portfolio.
Actual changes in the...
Yeah, I mean, some are light, others are complete overhaul, but yeah, we've got a bit of everything.
Makes sense. Makes sense. I will look, okay, here, just a moment.
Thank you. Claudia Hittay, Luxembourg Institute of Science and Technology. In the beginning of your presentation, you said that when you were showing the percentage of funds and assets under management in Article 8, Article 9, and Article 6, and you said that you think that there will be growth, but there will be some kind of ceiling at like 70, 75%. Why do you think that is?
Yeah.
Who is investing in non-ESG? Who are these?
Well, I mean, there are asset classes where you can't really do ESG, so commodities, where it's more challenging to do that as well in alternative energy. So depending on the strategies, there will always be strategies where you know, if you use a lot of derivatives, it's going to be a challenge. Now, I don't know where that bar is, you know, that threshold, I don't know, but interestingly, the NN fund that downgraded from 8 to 6, they mentioned commercial interest. They thought that there wasn't much commercial interest for a specific strategy. It was, I think, a credit strategy to have ESG considerations. So yeah, there will still be, for either asset class reasons or for commercial reasons, funds that would not be Article 8 or 9.
Anyone else? Well, I do have one, maybe, if we still have a couple of minutes. On the presentation, it was mostly focused on SFDR, the UK, and mostly European sort of classification system of investment funds. More globally, do we have anything comparable? And I mean, in the intention to classify or to give more transparency as to what's indeed in the fund and in the strategy.
Yes, so there is disclosure regulation almost everywhere. There's taxonomies also in a lot of countries that are being developed. So in the US, there's this discussion, I don't know if it's been, yeah, actually we did, it was a consultation because we responded to that consultation. They wanted to say to asset managers, you could classify the fund as either ESG integration, ESG-focused, or impact. So now they've seek feedback from the industry. I don't think they're going to go with ESG integration. It's just not a thing. Actually, the UK has also come to the same conclusion. So you will be left with ESG-focused and impact in the US, which is probably very similar to what the UK is having there. So yeah, I mean, that's the one I have in mind, but maybe there are other classification or labeling systems in other regions. But I know in Canada they're following, you know, the CFA classification. But yeah, I mean, clearly Europe is leading the way, and they will all learn for the lessons from SFDR implementation.
Thank you.
Hey, hello, thank you. My name is Laurent Kops, investment manager. I'm actually a bit confused, and I would like to hear a point of view. So 2 examples. The first one is, you told about decreasing investments into weapons. And this is a bit confusing because at the same time we see governments around the world increasing budgets towards weapons and defense. And the second example is more towards energy transition. France saying nuclear is good, Germany saying nuclear is bad. But at the end, we are in front of an energy crisis, and we say carbon, it's very bad. We should not produce energy with it, and we should change. It's more like the burning ship principle. Is this too fast? Is this the right moment? What is your point of view on these 2 examples?
I think the second question is quite broad, I think. So the first one was on controversial weapons. Is that right? So we haven't seen in the data, we actually haven't seen any changes. So ESG funds tend to exclude controversial weapons, and I think this is going to stay like this, even if but defense budgets have increased in certain countries, not all. And even if there's lobbying in some countries, Germany in particular, to have defense companies, excluded, considered more ESG. But clearly, controversial weapons will never be part of. Defense company will never be part of the social taxonomy. That's not going to happen. I know some have asked for that. So I think it's going to stay like this. ESG funds will continue to exclude controversial weapons. I don't know if that answers your question.
Yeah, it's kind of seeing the private market going away from weapons, the public market going more into weapons. It's a bit confusing.
Private sectors going into weapons?
No, private sector with ESG rules saying that you should not invest into weapons and defense, and at the same time, taxpayer money put.
Oh yeah, public money. Yeah, it's
and, it's just confusing.
Yeah,
to see the 2 point of views. On the one side, the government's with the legislator saying to the public market, don't do it, and at the same time doing it. So confusing.
Yeah, there will continue to be contradictions. That's one. There will be more going forward. I mean, it's, yeah. And the second question, sorry, I've already forgotten.
The second question is about energy transition and between giving up the old ways of producing energy and going more towards the new ones, the more greener ones. And
I think we're not doing less of the first one. I think we're not doing less of the first one.
I mean, in Germany,
we're investing, still investing in fossil fuels and more.
But
we're also investing in more in renewable, but we're certainly not divesting from fossil fuels right now.
We see a decreasing investments into the carbon or Kohlenwerke in Germany, for example.
Sorry, say again?
Yeah, sorry. We see a decreasing investments into coal production, Kohlenstoffwerk in Germany, for example. So it's more increasing investments in renewable ways to produce energy and more going away from existing ways of producing energy.
Well, as I said, I think we're not going away from, we're actually continuing to invest in fossil fuels. I don't think we're divesting from fossil fuels.
Okay. And this is ESG
like when you look at, for
compliant,
example, also what's happening in the US with the, what is it called, the inflation, can't remember the name of the Biden program. There is going to be more money into renewables, but they're also supporting normal, like global, oil and gas businesses. So we continue to invest in fossil fuels. Am I not right?
Yes, you are. Just talking facts, right?
Yeah. This is not an opinion. I'm just.
All right. Well, thank you. Are there further questions?
One more question.
Yep.
Hi, I'm Thomas van der Heyden. I'm CEO of an Article 9 technology provider. I was wondering whether you, or whether you know, or whether Morningstar has done any research into whether there's increased scrutiny on these downgrades, for example, from other stakeholders within the asset universe, that is sort of putting increased scrutiny on these asset managers, asking them why they've downgraded and providing justifications for doing so?
Well, we've done so. I don't know if others have, but we've certainly done so. This has been reported in the press as well. We'll continue in the next report to disclose the names. I remember, I mean, last year when I was asked the question by several journalists, or what do I think about potential downgrades? And I thought there could be a reputational risk. That's what I thought at the time. Is it going to play out? I don't know. As I said, it's probably too early to tell, to see if there will be, flows coming out of those funds. But I think, given I was going to say the mess, but the confusion the whole sector is in at the moment because of this. The vagueness of, the lack of clarity provided by the regulator around the definitions and the classification. I think we shouldn't be too harsh. That's my honest opinion, because they have an army of lawyers, and at the time they interpreted the text the way they wanted to interpret them. They probably interpreted them more loosely than other managers. But I don't think, it's what's the word? I'm getting tired now. I don't think it's a crime, right, that you downgrade funds from 9 to 8. Now, they probably did that, those ones that are doing it now are probably doing it earlier than others. Maybe if some others wait, that could be more consequences for those. But one thing I didn't mention, sorry, and I'm finished with that, is that because of the lack of clarity provided by the European regulator, national regulators have stepped in and kind of fragmented the market. So they've given, for example, the FMA in the Netherlands, Luxembourg here, the French regulator, the Irish regulator, they've provided different interpretation of SFDR. So asset managers have to deal with that. I mean, they are distributing their funds everywhere in Europe, and they're trying to, to work with this. So, I mean, this is a real challenge. So I would not be too harsh with those asset managers.
Thank you, Hortense. And thank you, everyone, for your questions and attendance. I would like to warmly thank again Hortense. So now we're going to have a few minutes break until the next presentation. Thank you very much.